Hello, and welcome back to the QuantScore Financial Show, brought to you by Maticians. In this video, we're diving headfirst into the churning sea of stocks that are looking a little risky, veering off course into treacherous waters. Remember, I'm not in the business of handing out financial advice like candy on Halloween. We're here to equip you, the savvy investor, with the intel you need to navigate these treacherous markets. Today, we're talking algorithmic prediction models, the kind that could make even a seasoned Wall Street veteran do a double take. Or at least we like to hope. These aren't your grandpa's stock charts. We're talking next-level quantitative trading strategies that are changing the game. So grab your trading apps and get your notepads ready for a wild ride as we break down which stocks are flashing red on our QuantScore radar. First up, let's talk GoDaddy, ticker symbol GDDY. GoDaddy, trading at a hefty $178.88 a share, might have you thinking they've cornered the market on internet domains. But hold your horses. A closer look at their price-to-earnings ratio, a whopping 28.34, might not seem terrible, but please do not let one metric fool you. GoDaddy currently has a PEG ratio of 3.35 with a forward PE ratio of 30.21, both indicating that the best of GoDaddy is definitely behind them. Their quarterly earnings took an absolute nosedive, dropping by 82%, while their quarterly revenues slightly jump, up 8% this quarter. As for the QuantScore, our algorithms logged a remarkable 33, implying this stock is at the top of our list of companies just screaming overvalued. Next up on our hit list is TPG Inc., the private equity bigwigs dipping their toes into the public market. Trading at $47.71, they might seem like a bargain compared to GoDaddy, but disregard the relative stock price. Their forward PE of 20.24 is nothing to write home about, and their return on assets is practically non-existent at just under 1%. And if that wasn't bad enough, their return on equity is deep in the red at negative 2%. It's like they're allergic to making money for their investors. Our QuantScore gave TPG a 28, not quite to the top level of GoDaddy, but still offering plenty of upsides for investors willing to bet against the market. Now, let's talk Roblox, the supposed darling of the metaverse. Roblox, ticker symbol RBLX, was most recently trading at $59.07. That PEG ratio of 8.18 is sending chills down my spine. And don't even get me started on their forward PE of 192.31. That's not a PE, that's a cry for help. Their return on assets is a pathetic negative 9.8%, and their return on equity is an abysmal negative 660%. Quarterly earnings growth, non-existent. Quarterly revenue growth, an actual happy figure, but not enough of a saving grace. Roblox was able to increase their quarterly revenue by 30%, but they have far too many negatives to justify trusting one positive financial metric. They're acting like they're flushing virtual money down a virtual toilet. Unfortunately, it is instead real investor money down a real pitfall toilet. Roblox has seen a major dip since their high of $75 in February, but we believe there is still plenty of room to fall. We just hope you do not get caught trying to catch a falling knife. Our QuantScore is ringing the alarm bells at an incredible 25, hoping you stop building and start selling. Now let's talk BJ's Wholesale Club, the bulk retailer trying to compete with the big dogs like Costco. BJ's has been around for a while, and they have a loyal customer base. But how do they really stack up in the financial arena? BJ, trading at $111.91, might have you thinking they're raking in the dough. But is that really the case when you dig deeper into the data? A closer look into their financials tells a different story. It's not all sunshine and rainbows when you peel back the layers. Their PE ratio of 27.98 may not seem drastically low, but when coupled with the rest of the data, it starts to paint a different picture. Although BJ's saw some improvement in their forward PE ratio compared to their current PE ratio, the growth is minimal and nothing to write home about. Similarly, with their PEG ratio of 2.78, the financials simply do not justify floating near all-time highs, and we strongly feel their loads may come crashing down. That's about as appealing as a year-old hot dog from their food court. Doesn't exactly sound like a tasty investment. Additionally, BJ's has seen a dip in quarterly earnings by nearly 16%, with a drop in quarterly revenue as well, but not nearly as severe at only 1.5%. It's clear that this company is struggling to keep up. The competition is fierce, and BJ's is finding it hard to maintain its footing. Our QuantScore is giving BJ a 19. A clear sign our algorithms do not trust this current valuation and feel BJ's has overstocked their shelves and struggling to turn over inventory. Let's talk about a recent favorite of the channel. Otis Worldwide Corp, the elevator and escalator giant, easing the way we lose and gain elevation. Otis, with a matching ticker symbol, OTIS, was most recently trading at $102.11, not far off their all-time high of $106.83. This may have you believing Otis will be taking you straight to the moon, but our QuantScore is definitely feeling this stock is stuck between floors. Their PE ratio of 25.25 isn't quite as high as the Empire State Building, but definitely getting close, and their PEG ratio of 2.55 is about as exciting as watching paint dry. Their forward PE of 25 might seem unreasonable given they plan to see no improvement in the future, and with a mediocre quarterly earnings growth of 6.2% and a quarterly revenue growth of 1.5%, it's clear this company is moving at a snail's pace, and we'd hate for you go get trapped in this elevator shaft. Our QuantScore is giving Otis a 13, a sign that this stock is overvalued and stuck in neutral. Let's talk insurance with the global insurance brokerage firm Brown & Brown, ticker symbol BRO. They have a long history and a significant presence in the market, but that doesn't always translate to a safe investment. BRO, trading at $122.93, might have you thinking they're a safe bet, but investors beware. This stock is about as risky as playing with fire. They currently have a PE ratio of 35.43, which feels higher than insurance premiums after a fender bender, and they're highest on our list as of now. It's a clear indicator the company may be nervous for another disaster. And don't even get me started on their PEG ratio of 4.41, suggesting the stock's growth potential doesn't justify its high price, and the idea of improvement is a thing of the past. That's about as appealing as a root canal. No one wants to endure that kind of pain, financial or otherwise. Their forward PE of 29.24 might tempt some, but it's important to look beyond the surface. But with a quarterly earnings decline 22%, it's a red flag for potential investors. They did see improvement in quarterly revenue, increasing 15%, but it's clear to see this company is struggling to keep up, with the financial reports paint a grim picture. Our QuantScore is giving BRO a 22, a clear teaser warning to tread carefully. Investors, don't get caught holding the bag when this bubble bursts. It's better to be cautious now than regretful later. Next up, we have Ryan Specialty Group Holdings, another player in the insurance brokerage game. Ryan, trading at $72.93, might seem like a bargain compared to Brown & Brown. But investors, don't be fooled by the low price tag. That PE ratio of 102.58 is higher than my blood pressure after a bad trade. And their forward PE of 34.13 isn't much better. Sure, their quarterly earnings growth of 0.39 and revenue growth of 0.252 might look promising, but with a QuantScore of 21.0, it's clear that this stock is still overvalued. Investors, there are better insurance plays out there. Don't get caught in this specialty trap. Let's wrap things up talking about the travelers' companies. The insurance giant constantly ranked at the bottom for customer satisfaction among insurance companies, with a 1.06 out of 5 with the Better Business Bureau. I suppose surprisingly or unsurprisingly, depending on your perception of big business, this terrible customer satisfaction and negatively directly translate into profits, as Travelers is currently trading just $5 from its all-time high, approximately a 2% difference. TRV, last trading at $264.46, currently has a QuantScore of 17, presenting plenty of opportunity for declining value. While their PE ratio of 12.21 sounds incredibly appealing, please do not let one simple metric dictate their value. Their forward PE of 14.2 also may seem reasonable, but it paints a picture of minimal to no growth in the future, and their PEG ratio verifies this, currently at 3.16. It's clear to see that this company is stuck in a slow lane and showing clear signs of strong overvaluation and definitely not worth their premiums. Investors, there are more exciting opportunities out there, so please don't waste your time with this slow-moving traveller. And there you have it. QuantScore's rundown of the most overvalued stocks that should have you hitting the sell button faster than you can say margin call, or snagging those put options before those premiums get more expensive than travellers. These overvalued stocks might be tempting to buy during the dip, but don't be fooled by their flashy numbers and big names. Our QuantScore algorithm has sniffed out the truth, and these stocks are about as stable as a house of cards in a hurricane. So do your homework, trust your gut, and remember, sometimes the best defense is a good defense. Stay informed, stay vigilant, and keep your eyes on the prize, because in this market, only the strong survive. Thank you so much for watching. Please hit the like button if you enjoyed the video and subscribe to the channel to stay up to date on all new videos. Thanks again, and until next time. Stay calculating, my friends.